I need boots on the ground. I want to crush this. Get an education right here. I'm making $1 million a year. There are no rules. Not if you want to win.
Let's talk about finance lessons from the second episode of Billion Season 2, based on my work experience at Goldman Sachs in New York City, and based on my work experience at the top hedge funds in the world. Now, please like, comment, and subscribe, and stick around, because at the end of this video, I'm going to grade the episode for Wall Street realism with a buy, hold, or sell rating. 3 topics from this episode that we will discuss are as follows. Topic 1, short selling, and 5 tips on how technical analysis works so that you can use technical analysis when investing to make more money. Now, in this episode, Axe wants to get even with his new enemy, Todd Krakow, for trying to hire Axe's former on-site psychiatrist, Wendy, by shorting a Chinese stock that Krakow owns called Analysts, with the help of Taylor's brilliance.
I got more on Krakow.
No, get your better half in here.
The microchips are supplied by a fake Chinese factory.
Booyakasha!
Short $2 million.
Topic 2 of 3 is Axe wants to hire Trader Mafee's intern Taylor. And so we will discuss how much money entry-level analysts make at a hedge fund. We will also discuss what to do if your boss underpays you because they feel threatened by you.
$750 a year. That's double entry level for an analyst.
Topic 3 of 3 is Bobby speaks on a panel at an investment bank called Spartan Ives. Now, is Spartan Ives supposed to represent Goldman Sachs? And is the moderator here supposed to be the CEO of Goldman?
How do you do it, Todd? How do you stay aloft?
By learning who you are.
You wouldn't know Pindar from Pantera.
Topic 1 of 3, short selling and how technical analysis works.
Since you're in my office, you think you know what he doesn't.
China's not just cooking the books, they're going full Iron Chef with that.
Accurate. Many hedge funds have gotten burned by not questioning accounting from countries like China. Now, it's getting better, but a rookie hedge fund analyst mistake is to pitch a Chinese company as a long, meaning a buy idea, because the valuation is cheap. Sometimes those earnings estimates and even company guidance is not as accurate as they should be. Now, the short thesis is also based on Taylor counting delivery trucks using satellites.
An article came out on satellite-detected discrepancies between Chinese sites and what had been reported by government statistics.
And after that, they knew they were being watched, so the truck started moving.
Accurate. Hedge funds have been using satellites for many years to count cars and parking lots to see if a company will make or miss earnings. And those factories that Taylor was monitoring were fake. And you really need to send your analyst to the factory in order to see if they are actually producing a product in order to scale conviction in a position. And Axe kind of alluded to this.
I'm going to war with Krakow and Guangdong, and I need boots on the ground. I want to crush this.
Now, when I worked in the hedge fund industry before I invested in Caterpillar, ticker CAT, I did a factory tour in Peoria, Illinois. And before I invested in potash, I went a mile under the ground in Saskatoon in Canada to see the mining of potash. Now, a top hedge fund manager like Todd Krakow would have had his analysts do the same. And I don't care what country you're in. You have to tour the factory if you work at a large fund. And I did this in 2012 at Tesla's Fremont factory. And anybody can do this. Now, all companies have investor relations departments with the contact details on their website. Just call them and ask to set up a tour as part of your due diligence process. Now, Taylor did some more research on the short idea and discovered this.
Can they scale up? Can they ship product?
Not if the microchips are supplied by a fake Chinese factory.
Booyakasha!
Short $2 million. Wake me up when the stock's down 10% from current levels. That's where we want to cover.
Accurate. Now, because Axe has some information, but not a lot on this short idea, he wants to cover when the stock is down 10%. And I'm assuming that this is not a large position relative to the fund size of Axe Capital. And since you can lose an unlimited amount of money on a short, booking profits of 10% is not uncommon. Now, on long positions, of course, we look at much more upside than 10%. And for more details on how a short works, please watch my video for Season 1, Episode 4 of Billions, where I explain shorting in a lot of detail, and the link is in the description of this video. Now, when Axe said to short 2 million, he would likely have said this instead to the trader Mafee. Short 2 million if the cost to borrow is not expensive. And what this means is when you short a stock, you call the sell-side prime broker like Goldman Sachs or Morgan Stanley, or the fictional sell-side prime brokerage firm in this episode called Spartan Ives. And then hedge funds are on the buy side. Then what you do is you ask the sell-side firm, what is the cost to borrow the shares? Then the sell-side firm will call and talk to the owners of the stock and ask them, hey, do you want to lend me your shares? I can pay you 5%, for example, on an annualized basis to borrow the shares of this stock. Now, if the cost to borrow is high, like above 10% on an annualized basis, then Axe would either make his order smaller or cancel the short unless he has very high conviction. And Axe or Maffei, who's the trader, would also check out the short interest ratio on this stock. Now, what that means is if the short interest ratio is high, then too many hedge funds are short the stock. And that's really dangerous because if there's any remotely positive news in the stock, then hedge funds will panic cover, meaning they'll buy back the shares that they're short, leading to a massive short squeeze, which will push the stock higher. So how do you calculate the short interest ratio? Well, it's the number of shares shorted divided by the average daily volume. Now, if the ratio is above 10, then many hedge funds will not short the stock unless they have very high conviction, because this means it would take 10 days at least of short covering by all hedge funds in order to get rid of all shorts on a position. Let's use an example by looking at GameStop, ticker GME, which was such a crowded trade as a short in early 2021 that it had a short squeeze that caused GameStop to rise almost 30 times in the month of January of 2021. And this caused a lot of hedge funds like Melvin Capital to go bankrupt. And you know what this is? This is the world's smallest violin. Now, just for fun, let's see what GameStop's short interest ratio is now. So let's go to fintel.io, and we see here that the short interest ratio is about 10 for GameStop, meaning it will take about 10 days for the shorted shares to be covered. And if we scroll down a bit here on this page, we see that the cost to borrow is 1.7% per year, which is relatively low. Please note, the data is not always accurate, but it gives you a general idea if a short is getting crowded. And for me, if the short interest ratio is above 10, I usually won't put on the short position unless I have insanely high conviction in my short thesis. Also, if you're short a stock with a dividend, with a high dividend, you're actually on the hook to pay back that dividend to the person you borrowed the shares from. Separately, how else can you tell if a short is crowded? Well, if the stock does not go down on multiple negative news events, then the negative news is likely priced in. The same thing with a crowded long. If the stock doesn't go up after multiple positive news events, then the positive news is likely priced in. Now, while Maffei is entering the short trade order, this happens.
After they've completed the order, send a tweet from my account. Say, who's supplying an ad attack?
From your account? Maybe a little blatant?
Good. I don't want to be subtle. I want them to know it's me.
There's absolutely no way this would ever happen. Hedge fund billionaires are usually secretive when it comes to trades. They're also often unemotional when it comes to competing with an adversary like Krakow. Separately, Axe Capital hires a replacement for psychiatrist Wendy with this dude.
Are you a hard badass Jack or no?
Sorry? Replace sorry with what the are you trying to say?
Okay, being confident is really important in business, I get it. But there's no way that a polished on-site hedge fund psychiatrist would talk to employees like that unless the writers of the episode are showing how awesome Wendy was. And this dude reminds me of this comedian right here. Quick side note, the actress that plays Wendy worked at a hedge fund earlier in her career, and she prepared so much for her role in Billions, and Tony Robbins actually gave her one-on-one coaching. Now, I recommend going to a Tony Robbins Unleash the Power Within event per this graphic, as it changed my life, and it's why I teach. He convinced me to teach. And it's a much better investment in you than any of my courses or MBA programs. Let's get back to the Anatech short to see if Axe's tweet made the stock go down.
Anatech had a brutal sell-off after hours. Recovered.
Shorted again. If it cracked this much from just a tweet, they're terrified.
Now, what Bobby did was stock market manipulation, which is against the law. And per this press release from the SEC in 2018, The SEC charged Elon Musk with securities fraud for a series of false and misleading tweets about a potential transaction to take Tesla private. And I love the Reddit crowd so much, but please, and I say this with love in my heart, please be careful in the future about talking about stocks, because I think the SEC might one day go after retail investors. Now, what is Bobby thinking on reshorting Analysts after he'd covered his short position?
Wait for the dead cat bounce. As soon as the stock's up 1%, start whacking bids again. It'll dump, maybe by half.
All right.
So Bobby wants to short it again when the stock starts to rise, as he sees 50% downside. And maybe Taylor did a little bit more research and has more conviction in the short thesis. He mentions as soon as the stock is up 1% shorted. But the reality is there is something called the plus tick rule, which means that on many stocks you can only short them if they go up a little bit on the last trade. And the plus tick rule is there so that stocks don't go down too quickly. Separately, did you notice how Bobby mentioned dead cat bounce? Now, from a technical analysis perspective, he means that the stock could be oversold given mean reversion, and the stock could bounce back before resuming lower, which is referred to as a dead cat bounce. Poor cats. Now, why does Axe think there could be a dead cat bounce? Potentially by looking at the RSI. And so technical analysis tip number 1 of 5 is the RSI, which stands for Relative Strength Index. And the RSI tells you if a stock is oversold and hence could rise given mean reversion, meaning a dead cat bounce. Now, if we go to Yahoo Finance and select the chart, we can add the RSI, which appears below the stock chart. Now, per this chart I made here for a pretend stock, if a stock goes down a lot in a short amount of time, then the RSI could reach 20, which is a very rough level where traders expect the stock to bounce from. Conversely, if the stock rallies too much in a short amount of time, then the RSI reaches 80, and hence it is now overbought. And traders sometimes sell stocks or short them near an RSI of 80. Only do this after you have thoroughly researched the fundamentals and valuation of the company that you're doing investment research on. Now, for the math on the RSI, please see this graphic right here. Now, the 20 RSI oversold level and the 80 RSI overbought levels are sometimes self-fulfilling, meaning traders go long when it's oversold with an RSI of 20 and vice versa at an RSI of 80, because they think that other traders will do that, as ridiculous as that sounds. In fact, some people even use 75 and 25 for the RSI levels to trade at, as they use game theory to front run or beat other traders to the trade. Technical analysis tip number 2 of 5 is trend lines. Per this example, we see that this chart is not breaking the support level trend line that we drew here in yellow. But once it breaks the trend line, as shown by the red circle, then technically traders might feel that the chart is broken, and buying the stock would be like catching a falling knife. And again, this is often self-fulfilling. Conversely, instead of support levels, you can also have resistance levels. Technical analysis tip number 3 of 5 is the 50 and 200-day moving average lines. Per this sample chart, the white line is the stock, and the yellow dashed line is the 50-day moving average, and the red dotted line is the 200-day moving average. The 50-day and 200-day moving averages are the average price of the stock over the past 50 and 200 days respectively. Now, if the stock holds the 50 or 200-day moving average after touching it at least a couple of times, then this is often a support level. Now, per the red circle you see right here, we see that the 50-day moving average yellow line breaks below the 200-day moving average red line. And traders think this is incredibly bearish, meaning bad for the stock, and hence they might sell or short the stock. And this is often referred to as a death cross. Now, if the 50-day moving average goes above the 200-day moving average, this is a bullish, meaning positive signal, and it's often referred to as a golden cross. And as with all technical analysis indicators, they are often self-fulfilling. Technical analysis tip number 4 or 5 is the ascending triangle. In this example, we see that the stock is in an ascending triangle formation, as it doesn't breach the top or bottom lines. Now, since the stock is rising in this formation, we call it an ascending triangle formation. And if the stock breaks out above the high end of the triangle, this is bullish, and vice versa is bearish, meaning if the stock breaks down below the low end of the triangle. Now, if the stock is trending down in a triangle formation, traders call this a descending triangle. Lastly, if the support and resistance lines are parallel, it is also often called a channel formation, and the trend is your friend. Technical analysis tip number 5 of 5 is the fill the gap formation. This is nutty, but I love this one. Per this example, this stock here gapped up from a price of about 25 bucks to a price of about 70. And this might have been due to an after hours trade when the company reported incredible earnings AMC, meaning after the market closed. And after hours, the stock gapped up from 25 to 70. That's what it sounds like. Many traders actually expect the stock to close or fill that gap between 25 and 70 before resuming higher, as outrageous as that might sound. Meaning, after the stock gapped up from 25 to 70, traders think it has to go down and touch 25, close that gap, before it can resume higher again. Again, this is self-fulfilling. And closing the gap can also work if a stock gaps down from 100 to 50 bucks. So there's a gap between 100 and 50. And some traders think that the gap at 100 must be filled before resuming lower. Now, when my shorts gap down like this and there's a massive gap, I would always cover at least half of my position no matter what. And please, 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 and I'm gonna do something ridiculous. I'm gonna get down my knees here because I care. Hi there. Please only look at the technical analysis after you've thoroughly researched the fundamentals and valuation and created your financial model to get your target price, which I teach in my courses and my MBA degree programs. Please do not look at technical analysis first. Do it after your fundamental and valuation-based analysis. And technical analysis doesn't always work. And solid due diligence when it comes to your thesis on the fundamentals and valuation based on your financial model are way more important than technical analysis. And do you know why we can't come up with the names of successful day traders? Because they do not exist. You can't make money consistently by only looking at technical analysis. Why? Because in the near term, stocks can go up or down due to random reasons like geopolitical news, releases, or government economic data. And to make matters worse, they can be black swan events that push stocks higher or lower that we can't predict, like 9/11 or COVID. And Nassim Taleb wrote a great book you should check out that sophisticated hedge funds read called Fooled by Randomness. And you can read Black Swan as well if you want to. Now, when I invest, I never make a position more than 5% of my portfolio. And so if a stock I own gaps up and becomes 7% of my portfolio, and if it's overbought with an RSI of 80, then yes, I do take profits so that my position size can remain at no more than 5% of my portfolio. Topic 2 of 3. How much money do new analysts make at a hedge fund? Axe really likes Taylor's financial brilliance, but can Axe even hire Taylor?
Congratulations on rooting this out. It's a very good day for us.
Thank you for backing the idea. It really means a lot.
What do you care? I know you already turned down a job here.
So Taylor is potentially smarter than Axe and also uses game theory strategy a lot, meaning thinking a few chess moves ahead, but 3D chess, like this next level dope graphic here. And kids say dope these days a lot, right? Or is it groovy? Groovy graphic, I don't know. My dad humor's awful, I'm so sorry. But we know that Taylor is more ethical than Bobby is. Now in this next clip, check out Mafi's face, who is Taylor's boss, when Bobby wants to meet with Taylor. Now what is Bobby offering Taylor to stay?
$750 a year. That's double entry level for an analyst.
Now, half of $750,000 is $375,000, which might be the starting compensation package that Bobby pays. But most hedge funds of size would likely offer well under $300,000 for an entry-level analyst position. Now, the base salary might be half of that at best, and the rest would be based on what their boss, the portfolio manager, decides to pay them in bonus season. And the compensation might also include benefits like retirement savings matching and maybe health insurance. So, the next time you have an interview and you're negotiating what your compensation should be, give a number that includes all of your compensation. For example, if your current base salary is $100,000 and the company gives you health insurance of $10,000 per year, daycare of $10,000 per year, and retirement savings of $10,000 per year, then you can say your total compensation package is $130,000, which can really help you negotiate for a higher salary or compensation at your new firm. Now, at hedge funds, portfolio managers manage a team of one or more analysts. And in the less likely event that a portfolio manager has an amazing year and makes the firm $50 million, then what happens is the portfolio manager often gets 10%, meaning a $5 million bonus. And often the portfolio manager pays the analyst no more than 10% of their own bonus, depending on how much value the analyst added and depending on how selfish the portfolio manager is. So the analyst would likely make a $500,000 bonus, absolute best case scenario in this example. Now, if the portfolio manager has several analysts reporting to them, then the 10% compensation per analyst is way too optimistic. And hedge funds can be incredibly political too, to the extent that if the analyst is really, really good, then the portfolio manager might feel threatened, thinking that they hired their assassin, so they might pay them only 1% to 2%. And I've seen this happen many times before, and it's so frustrating. Now, if any of you work for a schmuck like that, and if you think your boss sees you as a threat, and if so, if you think your boss or the portfolio manager does not want to keep you around because you're really good at what you do, then I want you to do the following. When your boss is not in the office, find a way to meet with your boss's boss, who's usually the owner of the firm, and take a chance. Take a chance and walk into their office and pitch them your stock ideas. You have nothing to lose if you think your boss is going to let you go. It's worth it. Especially since you have to be loyal to your family first. Please remember that. Now, if you find it hard to get a meeting with the founder, get to know their assistant well and ask them for help on how to get a meeting. And your boss's boss's assistant likely knows that the person you work for is not that nice. And so the assistant will help you if you ask. Please remember, closed mouths don't get fed. And if you can't meet with your boss's boss, then find another job or start your own fund and let me help you get a better paying job or with starting your company. Now, if you have a boss that screws you on your first bonus season, then in this case, one data point does make a trend. And don't stick around because they don't change. You know, fool me once, shame on you. Fool me twice, shame on me. Oh my God, I talk a lot. Okay, let's get back to Axe trying to hire Taylor.
Getting my MBA in Chicago under Eugene Fama, the Nobel laureate.
Come on, Farmer's an egghead. Get an education right here. I'm making $1 million a year.
So accurate in terms of getting the education by staying at Axe Capital. Now, Nobel laureates aren't all billionaires for a good reason, because theory cannot beat real-life practical experience. Now, the University of Chicago has more Nobel Prize winners in economics than any other university with 16. And this show is so well researched because the dude that Taylor wants to work for, whom Bobby called an egghead, named Gene Fama, won a Nobel Prize at the University of Chicago for his work on the efficient market hypothesis, which stipulates that all stocks have all the good or bad news already priced in, which is certainly not something that hedge funds agree with. And I did my MBA in finance at Columbia University. And most of the finance stuff I learned when I worked at the top hedge funds or at Goldman Sachs or in the venture capital sector were not taught in school. We learned a lot of useless theoretical stuff. And this is why I teach. And this is why I wrote this book called 101 Crucial Lessons They Don't Teach You in Business School, which Forbes humbly called one of the six books that all entrepreneurs need to read right now, along with these 5 books written by Peter Thiel, Simon Sinek, and others. Now, what is it that Bobby likes about Taylor?
You see things differently. That's an edge.
Accurate. Hedge funds always try to get an edge on trades. That's the word they call it, edge. And they like to hire people that think differently. And I think it's healthy to not just hire finance people to work at hedge funds, because you can always sell yourself as somebody with unique experiences that brings diversity, idea diversity to the firm. Now, hedge funds and Wall Street firms also love to hire athletes as they can perform under pressure. And I've worked with several Olympic medal winners in finance, and they don't freak out under pressure. The same thing with veterans. Please hire veterans. Separately, if you're trying to change careers, and if you're worried that nobody will hire you because you don't have experience, then sell yourself by saying what's different about you. If you're very young, say, I understand my generation and their use of social media, which is an asset because of whatever. Or if you think you're too old, which is rubbish, say, based on my experience in different industries, I bring the following skill sets, etc. And Taylor finally comes to an agreement with X.
What about a week-to-week deal?
Done. We'll prorate the million, 19,000.
19,230.77
Hourly,
$140.38.
Jinx. I don't know if people still say that. But as you can see, Taylor and Bobby are both wicked smart. And this will lead to so many entertaining future episodes from a game theory perspective. Topic 3 of 3. Is Spartan Ives Goldman Sachs? Bobby sits on a panel at a Spartan Ives event, and Axe goes after his new enemy named Todd Krakow because of this.
Hedge funds like Axelrods, they're out of ideas. So they cut corners and go looking for that black edge. But I'm good enough that I don't have to get close to the line.
Great drama, but this would never happen, as many large hedge funds have been investigated, and there's no upside to sticking your neck out with regulators potentially watching by criticizing a competitor. It doesn't make sense to do that. So here's Axe's response, which is great.
Really? What about the 45 million in fines you paid to the UK? Larry, you ever found yourself afoul of British law?
No, some of us have never run afoul of any international laws.
Okay, that's not accurate. If you're the most prestigious investment bank in the world like Spartan Ives is, there's no way that international regulators have not investigated them, because finance is highly regulated in every single country.
I didn't pick that panel by accident. I knew you'd incinerate it. You just made sure Spartan Ives is all the street's talking about for the rest of the month. They'll be killing themselves they weren't in the room.
And the only way they get in there next year is by making you their prime.
So what Bobby means by prime is prime broker. And so Spartan Ives is an investment bank. And one of the departments at the investment bank is their prime brokerage business, which is like what a retail stockbroker is for us retail investors, except a prime broker does that for hedge funds. And when you see a trading floor on television that is not the stock market exchange, it's often an investment bank's trading floor, which is where the sell-side prime brokerage firm like Spartan Ives trades for the buy-side clients, meaning hedge funds like Axe Capital. And prime brokers make money on the commission that they charge when you trade through them, and they make money by lending shares to hedge funds, meaning their stock loan business, so that hedge funds can short stocks. And the sell side often has brilliant options analysts as well that set up really complex option strategies for the buy side traders, and there are massive hidden fees in that. And usually the more complicated a financial instrument is, like insurance, for example, the higher the hidden fees. Now, in the second half of my vlog on season 2, episode 1, I explained how Taylor set up a very complicated options trade. But the reality is, many hedge funds wouldn't have an employee like Taylor that structures the options trade. Rather, the sell-side firms like Spartan Ives or Goldman Sachs would set this up. Now, why do we think that Spartan Ives might be Goldman Sachs? Because of this conversation from the district attorney's office about going after Spartan Ives.
What if we went after Spartan Ives? That's as big as it gets.
No, thank you. That place is a finishing school for Treasury secretaries.
Now, I worked at Goldman Sachs for 5 years, and although I loved it, and I loved the people I worked with, I understand why so many successful politicians come out of that place. And I'll explain that in a second. But the lawyer in that clip mentioned that the firm is a finishing school for Treasury secretaries. And 3 recent Treasury secretaries were former Goldman Sachs top executives, meaning Steve Mnuchin, Hank Paulson, and Robert Rubin. And Goldman Sachs doesn't hire the smartest people because they hired me. But they do hire people that are not as abrasive as other firms at times. And the interview process is like 40 interviews to get in. So they make sure that they hire people that don't ruffle as many feathers as what you might see at maybe other firms. And we all know that one bad hire can destroy the culture of any team. Let's talk about grading of this episode for Wall Street Realism with a buy, hold, or sell rating. Now, the episode did a good job of discussing the anatomy of a short idea and the use of satellite technology by hedge funds in order to get an edge on a trade, which happens a lot with hedge funds. However, offering $1 million to hire a relatively new analyst is highly unlikely. What's also not realistic is how Bobby's team sent a tweet from Bobby about a short position. This would never happen. Also, although I love the writing and the new character development of this episode, the Todd Krakow versus Bobby Axelrod conversation at the Spartan Ives panel about each other's government investigations would never happen, as most hedge fund billionaires don't badmouth the competition, and most of them maintain a low profile. As a result, I'm going to give this episode a sell rating. Please subscribe, and I will see you soon in our next reaction video when we react to Season 2, Episode 3. Thank you.